So this is the official start. If anybody was wondering when it's going to happen and what it looks like, this is it. That's my TV face. So first of all, good morning. Hello, everyone. Good morning to you and a very warm welcome. Thank you so much for joining us. We're really excited to have this opportunity to engage with you. We've got quite a few new faces, faceless faces that we're going to be engaging with. And so we're really thrilled to have this opportunity to do so. As mentioned in the invitation, we're not going to drill down into the DNA of what the indicators are about, but what we're going to be talking about is what the indicators are showing us. And so that's what this presentation is going to be about. We will, however, of course, with great pleasure and with great enthusiasm, set up any presentations, follow-ups that you would like us to unpack the actual indicators with you. So please don't hesitate to get in touch with me afterwards, and we'll do whatever is necessary to make sure that people understand. So let's just starting with Desiderata. So Desiderata is basically things that are wanted or needed. And so what we're going to share with you is things from a GRYPHON perspective that we consider to be wanted or needed. Just by way of introduction, this is the fabulous GRYPHON team. Joining us today are two of our portfolio managers. Aubrey is the lead portfolio manager on the multi-asset funds, and Ruben is our CIO as well as being co-portfolio manager. And then we've got Cassie as well. Kasparis Trianek, who is not just our youngin, our hip, fab and groovy youngin, but he's also our indexation guru. And just a brief introduction, GRYPHON is well established in 1988. We've been around a long time and we're good at what we do. We're independently owned. We like to consider ourselves audacious pioneers. And our focus is very much on low-cost, rules-based investing. So starting here, the future has an ancient heart. And it's just useful to always just have this as a tag reminder. What we see, what we experience is not a consequence of now. It's a consequence of choices and actions and decisions that have been made in the past. And similarly, future consequences will be dependent on the choices and actions that we decide on now. So as a base, we're using that as our starting point. And I just want to establish this point with absolute clarity. GRYPHON is very serious about two things. We're serious about indexation and we're serious about asset allocation. These are not plan B options for us. We don't have an active managing arm. We don't have a watered down light version of asset allocation. We do indexation with meaning, with purpose, and we do asset allocation with meaning and with purpose. The other point that I would like to just remind you of is that nothing happens in isolation. As the future has an ancient heart, so all of these things are connected, which is essentially the namaste, which is my heart, your heart, one heart. But that's a story for another day. Sorry, Ruben, I couldn't help myself. But nothing exists in isolation. So the simple reminder of that is the butterfly effect. And most of you will be familiar with the butterfly effect. But just to keep us grounded and to keep the minds from wandering, you will see that there is a butterfly on every single slide. So if you find your mind wandering, if you're wondering if you put sugar in your coffee and if you're going to get the meal right for this evening, bring yourself back to the butterfly, focus on the butterflies. And remember that everything is connected. There's an overarching rhetoric at the moment that what's most important is time in the market. And then with that goes the absolute certainty, oh, you can't time markets. Our view is different. Our view is that markets can be timed. You've got primary cycles and you've got secondary cycles. And secondary cycles we allow just to bob along with. But when it comes to primary cycles, we believe that those can be timed. And that's our simple approach. And most importantly, our purpose is not to be right. Our purpose is to protect and grow our clients' investment. We don't need to be right because there isn't a finish line. There isn't the awarding of a cup. There isn't a banner or a medal. Investing is an active, ongoing process. What is important to understand from our perspective is simply this. We have a philosophy that we stick to. We have a philosophy that we believe in and have practiced for a number of years. We are somewhat different from our peers. Neither has to be right and neither has to be wrong. It's simply a question of understanding what we do, how we do it, why we do it, and then what to expect from your client's investment, taking that into consideration. And now that I've done my philosophizing and my preaching, all that's left for us to do first and foremost is to take one deep breath in, everybody. Hold it and let it go. And so we are fully present. And so I'm handing over to Ruben. Ruben, over to you.
Thanks, Megan, and thanks everyone for joining us. All right, so let's just start with our asset allocation philosophy. Market research, academic research has proven that the most value when it comes to portfolio returns, investment returns over the long term is added by virtue of asset allocation rather than stock selection. We subscribe to that completely. Preservation of investors' capital is paramount to us. We believe that two things destroy investment value and investment returns. The first one is emotions, which we control by virtue of our rules-based approach, and costs is the second one, which we control by offering investors some of the cheapest available products in the market. As Megan indicated, our purpose is to avoid primary down cycles in order to preserve capital. And while we do tolerate short-term volatility, those are mostly associated with secondary market cycles, particularly in equity markets. We don't make forecasts. We believe that all the information that's necessary to be made, necessary for us to make decisions, is already embodied in prices. And this philosophy has been unchanged since our fund's inception in April 2014. So when it comes to a philosophy, we like to refer to this excerpt from the book, The Intelligent Investor by Benjamin Graham, which describes how investors should approach markets. And he simply says the following: to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework, i.e. our rules-based approach, for making decisions and the ability to keep emotions from corroding that framework. This book, and this is in the preface to the book, precisely and clearly prescribes proper framework. You must supply the emotional discipline, and we believe that's essential. So, all right, to commence, we find ourselves in a very unusual situation, a unique position, and we can ask the question, well, what's happened? Certainly, interest rates are rising, inflation is all of a sudden a reality. There's considerable volatility in both equities and bonds, and for the first time in a long time, those two are not diversified from each other. In fact, they are moving together. So the good old 60-40 portfolio is not providing investors with much protection these days. We at Griffon, in our multi-asset funds, have been out of equities since August 2018. So the question remains, how did we get here? So let's take a step back in time and have a look at that. Let's go back to what we consider to be the commencement of this prolonged bull market, the great financial crisis, and what was followed, namely quantitative easing. Quantitative easing resulted not in underlying economic growth, but certainly it had a price, it had an effect on asset prices. 10 years later, we had COVID. And once again, there was an extreme amount of quantitative easing applying to markets by central bankers. Once again, we had the impact in price and not in volume. And what we are left with and what we are facing today is inflation. To demonstrate that, we have this following chart from Bank of America, which details the following. On this vertical axis over here, You have in trillions of dollars the amount of quantitative easing applied to global markets by central bankers. That's this dark blue line over here. On the right-hand axis, vertical axis, you have the MSCI All-Country World Index, and horizontally you have the passage of time from 2009 till fairly recently. There's a correlation of 0.97 between these two lines. But what this describes to us very clearly is that the quantitative easing applied to the global economy by the United States Federal Reserve, China, Japan, Eurozone central bankers have flown into asset prices and not into the underlying economy. A final point here, one can see the extreme pickup in quantitative easing as COVID hit the global economy and the extreme bounce that you saw associated in asset prices. Now, these are only equities, but the same applies to property and related asset prices. The effect will be very similar. So there's no doubt in our mind that equities have enjoyed the substantial boost provided by quantitative easing. However, our concern is that the picture is in the process of changing. We are moving from quantitative easing to quantitative tightening. And what we have here is the balance sheet of the US Federal Reserve, the biggest central bank in the world, from February to August. And this just gives you an indication that the slope of that line is changing. The central bank is no longer expanding its balance sheet and providing liquidity to markets. In fact, it's contracting its balance sheet. And the impact, we believe, on markets will be substantial. So I referred specifically to COVID and the infusion of quantitative easing by global central bankers over that period. Once again, we believe it had an impact on price and not volume. What we'd like to show you here is that COVID quantitative easing resulted in nominal economic growth and not real underlying economic growth. What we've done is drill down into sort of the reality of underlying corporate entities which produce goods and ferret goods around the globe. And we'd like to show you why we come to that conclusion and why we have such conviction about that conclusion. So let's look firstly at MAERSK. MAERSK has been reporting phenomenal growth in turnover of close to 60% for the past few quarters. But if you drill down into their turnover growth, it's obviously a function of volume multiplied by price. In other words, volumes that they've shipped multiplied by average freight rates. And what you'll see here, and this has been consistent for the past few quarters, but we're just showing you Q2 2022 versus Q2 2021. And you'll see that loaded volumes in all their various shipping lanes have in fact declined. Over this last quarter, down 7.4% in total. Average freight rates, however, have picked up dramatically and in fact are 64% higher than they were 12 months ago. So we make the point that this is not about volume growth. This is about price growth, and price times volume gives you turnover growth, but the underlying volumes are not growing. Well, you may say MAERSK is not the only company in the world. So let's look at a company that digs out raw materials, which everyone uses in their produce and what they produce. Let's look at Anglo American. From 2020, where their underlying EBITDA in billions of dollars was 9.8, down to 2021, where their underlying EBITDA grew to almost 21 billion, a phenomenal growth. But what you see here is that the bulk of the change, in fact, almost all of the change, is a function of the increase in commodity prices. Now, bear in mind that the rest of the globe buys those commodities. Their sales have grown as a result of the increase in those commodity prices, but those commodity prices become inputs to other companies. And so what we have here is a situation where helicopter money and quantitative easing have not produced economic growth. And economic growth is fundamental, we believe, to equity valuation and investment returns. Helicopter money and quantitative easing have produced inflation. And while the Fed did for a few months try and tell us that that inflation was transitory. We believe that the inflation has in fact morphed from goods to services. And as we'll show you, we believe that to be a significant problem. Asset prices are impacted specifically when it comes to inflation, and we'd like to just show you the following chart. What we have here is on the horizontal axis, the S&P price earnings ratio, and on the vertical axis, the US Consumer Price Index. Every dot represents the US Consumer Price Index and the S&P earnings ratio for every year from 1961, including 2009, because that was a significant outlier. And that's plotted on this chart. When we graph an exponential curve into that chart, you will see that when inflation is high, the S&P price earnings ratio has generally been low. So in terms of where we are right now, inflation is at roughly 8% in the United States, and the price earnings ratio on the S&P is 21. You can see we are very far from where this fitted curve should actually be. Now, may I make the following quite clear. We agree, like everyone, that inflation has peaked. We are certainly not arguing that inflation is going to remain at 8%. We see the decline in the oil price and energy prices. We agree with that. But what we are concerned about is that inflation remains higher for longer. We think that markets are currently discounting that inflation will drop to 2% quite swiftly. We don't believe that will be the case. And we are particularly concerned about some components of inflation, which I will discuss in a few minutes' time. What I would like to indicate here, though, is that should this curve fall to a price earnings ratio on this fitted curve, should this point fall to that curve, we could end up where inflation is just over 4% and the price earnings ratio on the S&P is in fact just around 15. So let's look at the impact that that would have on financial markets. On the 12th of August, the S&P was roughly 4,300, trading at a price earnings ratio of 21.7 multiplied by earnings of $198. Assuming inflation is at 4%, that $198 is going to be priced at roughly 15 times PE ratio, which will give you an index value of around 3,000, which implies the potential decline in the index of around 30%. Now, these numbers are not absolute, but this is certainly sufficient to give us cause for concern as to whether equities are a good investment at this point in time. So let's consider our thesis that inflation is not necessarily transitory, and we may not fall to 2% as quickly as the market is currently anticipating. The Atlanta Federal Reserve publishes the following. They take the US CPI basket and they split it between what they call flexible CPI and sticky CPI. Flexible CPI is things like gas prices, petrol prices, oil prices, the price of transport. And you can see that this is quite a volatile series, although for the last 20, 30 years, it's been exceptionally well behaved around a medium between -5 and +5. The other components of CPI, as I indicated, they refer to as sticky CPI. And these are the components of CPI which tend to decline and don't move as quickly and as volatilely, but when they do move, they tend to be very difficult to get back into a particular range. Now, one of the things that has allowed financial prices to be elevated for a considerable period of time is that this sticky CPI has remained incredibly well behaved for the past number of years. One goes back to the 1970s, one can see how that got out of whack, and it required extreme behavior by Volcker, who was the chairman of the Federal Reserve at that point in time. But this move of sticky CPI beyond 5% for the first time in more than 30 years is something which concerns us greatly. So here we have the two charts together, and just a reminder that inflation per se is not the problem. What we are looking for in terms of deriving value for our investors is underlying real economic growth. Inflation is very hard to control by central bankers, and it means that delivering global real economic growth becomes incredibly difficult. We're not sure that financial markets are taking cognizance of that right now. As another example, we'd like to just show you the cost of owner-occupied rent, which shows a very similar chart to that sticky CPI. This particular component of US CPI is more than 30% of the basket. And once again, it reflects a considerable uptick with a lag. And so we believe there are still considerable moves to come from this owner-occupied rent, as it reflects the cost of housing, the cost of ownership, the cost of rental in the USA. And then a final concern, the US Employment Cost Index, which once again has been incredibly well behaved for a number of years, but has recently become elevated, considerably elevated, to the points that we haven't seen levels like these since the 1990s. So this focus on inflation and sticky inflation in particular leads us to believe that the Federal Reserve, despite what they are saying today and said last night, may have more of a battle to control inflation in the longer term than markets currently anticipate. So to summarize, from that period of quantitative easing subsequent to the financial crisis, we've seen the asset price impact. Once again, more quantitative easing after COVID, where we believe we've seen a recovery in price and not volume. This has delivered inflation, and we firmly believe that our current positioning in cash is the most appropriate stance for our investors. Remember, our focus is on real inflation-adjusted returns, real returns from our investments. And we believe cash provides us with those real returns and the flexibility to act should opportunities present themselves. Now, some of the pushback to this view that we get from investors and prospective investors is to say, but hang on, China can rescue the global economy, as they did in 2010, 2011. Can't they likewise pump prime the global economy, pump prime commodity prices, and give us growth as they did 10 years ago? We are less sure about that for the following reasons. I'd like to just show two charts. What we have here is in green is the US PMI, or Institute for Supply Management Index, and the Chinese equivalent PMI. When these diffusion indices are above 50, it generally indicates economic expansion. When they are below 50, it generally indicates contraction. And just to show you how tightly they are integrated over the course of the past almost 20 years. So what that tells us is, while these two economies are sometimes at loggerheads with each other, it's very difficult for the one to grow without the other. And we contend that while China is faster growing, it is still not the size of the US economy. And so while there may be a pickup over here in the Chinese PMI, one can see the overall trend in the US economy is certainly moving in the direction of going slower. So while China may pick up, and I must be honest, more recent news events out of China are indicating that that pickup is in fact slowing down, and you can see that slight downturn there. We don't believe that China is the solution to the globe's real economic growth problems. And then just the final chart on this particular topic. What we have in blue here is the dollar index, and you can see that this price curve is inverted on this axis over here. And we have the oil price on this axis over here. If one goes back in time, one can see that the oil price rises at roughly the time that the dollar goes weaker. So stronger oil price, weaker dollar. And one can see that these lines have moved in tandem over a very long period of time. But what has us concerned at this point in time is that we've seen huge strength in the dollar simultaneous with strength in the oil price. So this confirms to us that the strength in the oil price is a function of supply issues rather than demand issues. And the real strength that we are seeing in the dollar is something which concerns us because our overall view is that the dollar is a risk-off currency. And when the dollar does strengthen, it's often indicative of an issue in the globe and underlying economic growth that we need to be on the lookout for. So just to answer that question about China, we certainly don't see it as a source of prospective growth for the global economy. A second question that we often have is, what about South African risk assets? And just to emphasize, we see both bonds and equities as risk assets. I'll show you a chart a bit later, but they both give investors returns over the long term, but they also both experience drawdowns which are debilitating to investors' wealth. So we don't like South African growth assets for the following reason. I'll show you a few charts which reflect that the US yield gap, the difference between the 10-year and the 2-year bond, are indicating recession. South African markets are not immune to global events. South African large caps are mostly internationally focused, and we don't believe that bonds are yet offering value. So this really is the yield gap, the difference between the 10-year constant maturity treasury and the 2-year, and this has been a superb indicator which portends economic recession in the USA. For the past number of years, we had a huge argument with most of the market in about 2019 when this touched the zero line. We had a very short COVID recession, but once again, to emphasize that that recession was unwound by the excessive QE provided by central bankers. We're now in a position where it's distinctly through the zero line, and that has us very concerned. So to those who say, well, let's invest in the JSE because it's offering value, we would just show the following chart. This is the quarterly change in the price of the S&P 500 and the quarterly change in the FTSE JSE All-Share Index. They seldom do not move together. And all we are saying is, when Wall Street sneezes, the world catches a cold. And so South African assets, no matter how cheap they are, will not escape a drawdown in the US. When it comes to equities, we are also concerned that a very large component of our all-share is in fact internationally focused. We've just given you stocks on this little graphic over here, their percentage in the index, and the extent to which we have classified them internally as local or international. And one can see here that many of our very large cap stocks are internationally focused. So for an investor to invest in South African equities and get local exposure only is actually not all that easy right now, to build a diversified portfolio of local only focused stocks. And then just to address the issue of bonds. Certainly, there's no doubt that bonds provided a great return for our investors just after COVID, where we exposed our funds to bonds at about a yield of 11%. It proved to be a great investment. There was a moment at the end of June where bonds once again traded above 11%, but we elected not to invest. And I'd like to just explain why that was the case. So what we've given you here is the difference between the generic South African bond less the generic US 10-year bond. And the spread between the two gives an indication of how valuable we believe South African bonds are. So to go back to the period that we last bought South African bonds, the SA long bond was trading at a yield of 10.15. The US long bond was trading at 0.58, giving us a spread, or as we like to call it, a margin of safety when we invested in South African bonds. Bear in mind that after COVID, there was a credit downgrade. And so that when it comes to the 30th of June, while we were trading at 10.98, the US long bond was in fact trading above 3. And that margin of safety was not yet at the level that we found attractive. So we believe that there has been a change in circumstance in South Africa, and US long bonds have become quite elevated. I think they're slightly lower currently at about 2.8, but we still do not see the margin of safety between South African bonds and US bonds, which entices us back into South African bonds as an investment. So just to look at our current asset allocation, we have recently been described as PERMA-BEARS, and I'd like to just chat about that for a few moments. We don't see ourselves as PERMA-BEARS. There's no doubt that when it came to us speccing this product, these multi-asset funds, and it remains our belief that South African equities are the preferred asset class if an investor wants to generate inflation-beating returns. That has not changed. That is our firm belief. And when we designed these products, it was our anticipation that we'd be exposed to equities for 80% of the time that we managed these products. However, the past 8 years, 100 months that we've managed this product have been very different to our anticipation. And bear in mind, our overarching approach is that we want for our investors the best risk-adjusted return option. So how has that panned out, and what have we delivered? I'd like to just show you the following chart, please. And if I can just run through the various colors in the chart. The purple line is the Griffin Prudential total return from the 1st of April 2014 till the 31st of July 2022. The blue line is the all bond total return over that same period. The red line is the FTSE JSE All Share Index total return over that period. The green line is the cash return, and the black line is the average of the multi-asset high equity fund in the South African CISCA space. So what I'd like to demonstrate here, just a few things. The purple line has trended higher, and while it does decline at times, the extent of the decline is substantially less than equities or our peers. In fact, when we've moved into risk-off mode, you can see that our focus is almost solely on capital preservation. We've delivered a superb return year when we bought bonds, and subsequent to that have generated returns in terms of cash, international cash, and near cash instruments. But what we would really like to show you is the degree to which capital has been preserved every time there has been a drawdown in equity markets. So once again, just to emphasize that we don't see ourselves as PERMA-BEARS. We do believe in equities, just not at this point in time. Our focus is on real expected returns, and we don't see that coming from equities in the near term. Just to look specifically at our returns from the point that we exited equities on the 29th of August 2018, and this gives an indication in terms of what an investor would be worth had he or she invested 100 Rand in the Griffin Prudential Fund, 100 Rand in cash, 100 Rand in bonds or equities. And one can see that we've outperformed all those asset classes. In fact, this slide is internally to us an indication of whether we are adding value for our clients and prospective clients or not. And once again, this shows that we've managed to choose the right asset class and generate the best risk-adjusted return for our investors. So this is our current positioning. We are exposed to local cash in 55% of our funds, US dollars in 15% of our funds, and Swiss franc in 30% of the funds. In conclusion, we believe that we've demonstrated to investors unemotional but disciplined asset management. We've preserved capital, and we've given you superior returns, but not only superior returns. We've given you those returns at exceptionally low volatility. And in periods when we are out of risk assets, we've given you uncorrelated returns. Our objective is to continue to provide equity market returns, but as I indicated, we want to avoid those primary bear market drawdowns because they are so debilitating to investment returns. As Warren Buffett says, there are two rules to investing. Number one, don't lose money. Number two, don't forget rule number one. We also believe our funds are very cost efficient. And then finally, provide great diversification based on our unique management style. And one can see how we differ significantly from our peers in this respect. Thank you very much for your time. Are there any questions, please? Megan, over to you.
I don't have any questions. I'm invested. I'm all in. So I'm okay. Guys, if there are any questions, please feel free to turn your mics on and pose them now. Alternatively, if you would like to send us a mail or get in touch with us afterwards, we have recorded the session and we will be sending a link, and we will also send a copy of the presentation to everybody as well. So yeah, we'll leave it a moment or two. If there are any, I can hear the cogs whirring, and yeah, so if you would like to pose a question, you're very welcome. Tom Bell, SA bonds are pushed as a good investment. Oh, that disappeared. Oh, sorry, I didn't know nothing. How can it be sustainable at so SA bonds are pushed as a good investment. How can it be sustainable at these yield levels? Thank you, Tom. Aubrey?
Is the problem we see with bonds point in time is that they very much correlated with equities, not only locally but also internationally. So it is a risk asset, and that's a problem. And we see it whenever there's a risk of time in the market, the bonds sell off as well. And one can actually go back in time as well in the big risk off times, 2008, 2002, 1987. One see those risks blowing out. At point in time, our indicators tells us that there's a higher risk in the market. So we're not foreseeing a crash, as to call it that, but it may even that markets just bobble along for 2 or 3 years and just do nothing and just give a lot of volatility up and down. And that have shown us in the past that it's better to sit in cash, make use of other shorter term opportunities. And that's the way we point in time see it. And the local bonds, we did get that credit downgrade, and there's a couple of other worries point in time with Eskom and whatso else. One need a bit of more margin to see us going back into that, or for risk to subside a bit and to get to a point where we see the growth cycle turning. Point in time, the real growth cycle is definitely going downhill. And in the past, risky assets haven't responded positively until one could see that bottom turn in the real growth. Ruben, I don't know whether you want to add something as well.
No, just to emphasize the point that Aubrey made, that global bonds and global equities have been behaving differently to the historic past, where They, in fact, provided investors with potential for diversification. We believe that as a function of QE, those risk assets have, in fact, become increasingly correlated. And as a result, that's been a source of caution for us. Thanks, Megan. Anything else?
All right, no, so we haven't received any other questions. So what I do expect is to see an incredibly large number of inflows, because obviously everybody's on board. You'll be pleased to know we have space. We have space, and we look forward to the inflows.
If I may.
Yes, of course,
I
with
did actually
pleasure.
put a question on there, but it hasn't obviously come through.
Well, thank you for following through. Welcome. Thank you.
Can I just perhaps just verbalize it and
Please
maybe
go
someone
ahead.
answer it? And the question is, do we expect equity markets ever to return to the predictable pre-215 levels? I'll switch off.
Thank you.
Are you going to take that?
Yes, it's a difficult one in the sense that we don't like to make forecasts, like we already said. But yes, I think it's very much possible, but one will have to see the world global equity economic cycle turning positive, and the real growth cycle turning positive. And I believe that if governments do the right thing, and what is the right thing? I think by investing themselves and creating real growth in that way, and not by helicopter money, one will kickstart the economies and get it growing again. And yes, then I think we can get a lot higher than those levels.
Thank you.
Ruben, do you want... Thanks, David. Ruben, do you maybe want to add anything to that?
No, but just a reminder to investors that, you know, we have had periods, as Avi said, we've had periods where equities have delivered very low returns for investors, not only in South Africa, but we can go back to the 1970s in the US. From the beginning of 1970 to the end of 1979, the S&P delivered over that entire period a return of just over 10%. So on a compound average growth rate, a particularly poor return, and particularly relative to other asset classes. And then once again, after the NASDAQ bubble, you know, it took the NASDAQ a number of years to get back to those very elevated levels. And it took the S&P also an extended period of time of virtually no performance to get back to the levels that it was at in the beginning of the noughties. So the principle remains that equities, South African equities in particular, are our asset class of choice, but there are times where we believe they should not be invested in, and this is one of those times.
Sorry, Megan, guys, looks like my question also didn't get through. Hi.
No problem.
So if inflation is here for longer, and I don't necessarily understand them or the pricing of them myself very well, that's why I would leave it to you. But does inflation-linked bonds then not make sense, or not? Thanks.
Okay. I like inflation-linked bonds, but in South Africa they're very illiquid, and that's one of our philosophies, is only to invest in liquid assets, because yes, it's possible to buy it, but to sell it is difficult. So point in time, I believe the linkers is giving you quite a pickup. I think they're underpriced relative to the nominals, but they're illiquid. I think pension funds hold about 60% of them, and the banks another 20%. So 80% the possible linkers, like fixed hands. So for that reason, they're very much illiquid. Foreigners got about nothing. So yes, we like the linkers, but it's an illiquid asset class, unfortunately. For us, and our funds are small, but the philosophy is we must manage it in such a way, whether it's a 10 million fund or a 10 billion fund or a 100 billion fund, it must be able to deliver the same returns. And there's Megan very right. I don't think we'll ever cap the funds because the philosophy is scalable and replicatable. So one can replicate or one has to be able to replicate the performance, and that was the way we built the fund. So that size will never have a issue, or when the funds are small, have a better return than when they are big.
So we can handle the zeros. Bring him on. All right. Yeah, for some reason I'm not getting the chats, the written questions. But so if anybody has an issue that they would like to raise.
I think I can see no other questions. I see Mike's and David's.
Okay. All right. So if there are no other questions, anyone? 5, 4, 3. All right, we're opening the doors. The apps are welcome. Please feel free to drop us a mail. We'll gladly set up follow-up discussions. We really appreciate the opportunity to talk to you. Thank you for joining us. It's been an absolute pleasure. For those of you, Mark, I see you clapping. I'm loving it. Woo! For those of you who have not just invested with us, but who have engaged with us, our greatest appreciation is for the critical thinkers, for the people who have the opportunity to take the time, the effort, the opportunity to actually engage with us and pose questions to us so that they can understand. I watched a wonderful video yesterday, some footage of Steve Jobs, and the way that he approached things, his courage and his perspicacity is just so inspiring. And it is, for me, it's very closely aligned with the way that Griffin approaches things. And I'm just going to say that nobody has seen Ruben and Steve Jobs in the same room. I'm just going to say that and leave it there. I'm not saying it is. I'm just saying nobody's seen them in the same room. So, guys, thank you very much. We really do appreciate your attention, and we look forward to engaging with you. Thank you, David.
Mag ek
Sorry. Yes.
Ek wil graag net van die geleentheid gebruik maak vir skoon Afrikaans om die span om die span te komplimenteer met 'n uiters professionele aanbieding. Ek het dit uiters sinvol en uiters insiggewend gevind. Baie dankie vir bytwerk. Dit word waardeer.
That is so appreciated. Thank you very much. Thanks, guys. Take care. Stay warm. Bye-bye.